this computer. All right, to sell variable. Okay, so anything that has the word variable, all right? Anything that has the word variable, you have to think securities license. Life license, you need it obviously, but you also need your securities license. So A is true, A is good. A life license, yep. Securities SEC registration, no. You need FINRA registration. FINRA is in charge of helping people get licensed. FINRA. So that's what you're going to be doing with FINRA. So SEC is the answer because that's the only accept. Get it? Any questions on that?
No.
What kind of policy issues certificates of insurance to insureds? Any certificates is only on group insurance. Like when you're an employee of a group policy, you're going to get a certificate of insurance. Everybody else, if you get an individual policy, you get a what's called a policy, a contract, right? So certificate is not a policy. Certificate is something that, so the owner of the policy is the business owner, and he gives out certificates to his employees. Make sense?
Yeah.
All right, cool. Give me 1 second. I need to do something real quick. It's not letting me. Give me 1 second, okay? That's weird. It's not letting me do what I want to do. Okay, whatever. That's fine. All right, so here we go. Group insurance. Okay, next one. Which of the following is called second to die policy? The answer is survivorship life. So survivorship life, it's second to die. In other words, the survivor dies. First to die is anybody that dies first, right? But last to die or second to die is also called survivorship life. So there's two types of those. When it covers two people or more, it's a joint life. But if it covers, but joint life just covers two people or more, and it pays out. The policy pays out when the first one dies. Joint and survivor or survivorship life pays the last one to die or the second to die. They have the same name. Make sure you screenshot these so you can have them in your camera roll later on. You could review them with the rationale, because I'm not reading the rationale. Twin brothers are starting a new business. They know it will take several years to build the business to a point that they can pay off the debt incurred in starting the business. What type of insurance would be most affordable and still provide the death benefit should one of them die? This is exactly what I was just talking about. So this one is, should one of them die? That means the first to die. That means joint life. You see that?
Yeah.
So if you know joint life and joint and survivor, joint life is first to die, joint and survivor is last to die, then you're gonna get this one pretty easily. And insured, let's see. An insurer has life insurance policy that requires him to only pay premiums for a specific number of years until the policy is paid up. What kind of policy is that? Well, paid up means that it's till age 100. So that means it's a whole life. And he's only going to pay for a certain number of years, so that's limited paid life. See that? Go ahead and screenshot that. In a survivorship life policy, when does the insurer pay the death benefit? Last death. We just went over this, right? Survivorship, last to die, survivorship, second to die, survivorship, last death, same thing. They're all the same thing. Which of the following determines the cash value of a variable life policy? Which of the following determines the cash value of a variable life policy? The cash value is the performance of the portfolio because it's variable. It all depends on how the stock market does, how the investment does. You see how that works?
Yeah.
That's what's gonna be the difference maker right there. All right, cool. Let's go to the next one. When an insured under a life insurance policy died the designated beneficiary receives a face amount of the policy as well as a refund of all premiums. Which rider was that? That was a return of premium. Return of premium rider. Go ahead and screenshot that. What type of insurance would be used for a return of premium rider? Increasing term. It's going to be a term insurance for return of premium, and you use increasing term.
Mm.
All right, give me 1 second. Let me do something real quick. There we go. All right, cool. Let's go. Let's continue. An individual purchased a $100,000 joint life policy on himself and his wife. 8 years later, he died in the automobile accident. How much will his wife receive from the policy? So this is a joint life.
Mm-hmm.
That means he's going to receive money when the first one dies. And who died? The husband died in a car accident. So the policy is going to pay $100,000. Now, if this said it wasn't a joint life, if it said it was joint and survivor, then now how much would the wife receive?
I'm not sure.
The answer is 0. She wouldn't receive nothing because it only pays out when the survivor dies. In this case, the survivor is a wife.
Mm.
The husband dies, nothing pays out on joint and survivor. The wife dies, now it pays off. Who gets the money?
Mm.
The kids get the money. The beneficiaries get the money.
Okay.
That was good. All of following statements are correct regarding credit life insurance except. So credit life insurance is insurance you get when you borrow money. So let's say you need $20,000 from the bank and you qualify. The bank says, all right, I'll lend it to you. But then the insurance company says, the bank says, but I'll lend it to you with the one condition: you have to get life insurance, because if you die, I want my money. If you die, I want to get paid. I want to make sure that I get paid my money. So that's how joint and survivorship life works. Credit life insurance works. So here it is. All statements are true regarding credit insurance are true except benefits are paid to the borrower's beneficiary. No. That's the answer. A. Because benefits are not paid to the beneficiary. Benefits are paid to the bank because you owe money to the bank. Get it?
Yeah.
All right, cool. If you review this video over and over, it's going to start clicking. And that's one of the things I'm going to recommend you and whoever's watching this video, replay video, do, is make sure you watch these videos over and over, because there's nothing else that you need to know on credit life insurance unless they ask the question differently. And then you're going to learn a different thing, a different way of answering this question anyways. So don't be afraid. Don't be afraid. What the heck? Don't miss out on this opportunity to learn by watching this video over and over. The good thing is that it's on YouTube, and YouTube allows you to rewind, replay, pause, answer before I answer, just to test your knowledge. It's really good. Which of the following is not allowed in credit life insurance? Credit requiring that a debtor buys insurance for a certain insurer. That's the answer. It's not allowed that a creditor, the bank that's lending you money, to tell you where to buy your life insurance, from which insurance company to buy life insurance. You could buy it from whoever you want to buy it from. Okay. Next one. Oh, we're done with this question, this quiz. All right. Always review the questions you got wrong. In this case, we didn't get none wrong, so we're just going to go to the next one. Quiz. And let's see. Here we go. Which of the following is true if the policy owner exercises his right to surrender his life insurance policy for its current cash value? Assume that the policy owner and insured are the same person. Well, if you surrender the policy, beneficiary can sue the policy for the cash value of the surrender. No, the beneficiary, if the policy owner cancels a policy before the insured dies, beneficiary has no say. They can't sue. It's not their money. It's their money when the insured dies, but right here the insured hasn't died. The policy owner is just canceling his policy, surrendering the cash value, right? B, the beneficiary
Mhm.
automatically receives cash value? No. Beneficiary doesn't get nothing until somebody dies. C, the insured is no longer covered under the surrender policy? That's true. D, the insured is still covered under the policy, but the death benefit is reduced? No. If you surrender a policy, the policy cancels. So
Mhm.
C is the answer. Go ahead and screenshot that right there. All of the following are true statements regarding the accumulation at interest option except. Accumulation at interest option. Okay. The policy owner has a right to withdraw the accumulations at any time. I think so. The interest is not taxable since it remains inside the insurance policy. That makes sense. The annual dividend is retained by the company. The interest is credited at the rate of specific. I think the answer is C, but I'm wrong. B, interest is not taxable since it remains inside the policy. Oh, so you have to pay interest even if it's inside the policy. Yeah, I mean, you have to pay taxes.
Mhm.
Even if the interest is inside the policy, the dividends. All right, I got it. What is the purpose of a fixed period settlement option? By the way, Gris, if you have questions, ask, okay? Don't hold
Okay.
back.
Yeah.
What is the purpose of a fixed period settlement option? Fixed period to provide a guaranteed income for a certain amount of time. The settlement to settle the insurance company's liabilities to provide guaranteed income for life to provide a guaranteed amount of each. Fixed period settlement option is to provide income for a certain amount of time. The answer is A. Because you're the word said is right. It's fixed period, so you're gonna get income for a fixed period of time.
Mhm.
The beneficiary or the annuitant. The policy owner pays for her life insurance annually. Until now, she has collected a non-taxable dividend check each year. She has decided that she would rather use the dividends to help her pay the next premium. What option would allow her to do this? Well, it's in the answer, right? She wants to use the dividend to pay for the premium. So this is a reduction of premium benefit. Okay, next one. Hold on. Next one. What limits the amount that a policy owner may borrow from a whole life insurance policy? The amount of cash value that it has. I mean, if the policy doesn't have any cash value, there's no money to borrow. So guess what? Since there's no money to borrow, then there's no cash value. Then you can't borrow any money because there's no cash value. Sorry, give me 1 second. Next one. Which of the following named beneficiary would not be able to receive the death benefit directly from the insurer in the event of the insured's death? Former wife is a seasoned insured. The minor. It's a minor. There it is. So obviously, if the person is a minor, they can receive income. If the person is a minor, they can receive a death benefit. I mean, it's they're not gonna be able to receive a death benefit. So you have to be an adult to receive a death benefit. Which of the following is true about class designation? Class designation is allowed? Yes, it is. So A is wrong. It determines succession beneficiary? No. Beneficiaries are not identified by name? That's true. Beneficiaries must be part. Whoa, refresh. Beneficiaries must be part of the insurer's immediate family? No. So class designation means this: all I want my benefits to go to my children in equal shares. All children equal shares. That's what this means, right? So
Mhm.
instead of naming my children one at a time, Ruby, Marina, Esmeralda, it's saying that I could just name all my beneficiaries in one class designation. All children equal shares. That's what that means.
Mm-hmm.
If a fixed settlement option is not chosen by the policy owner or the beneficiary, which option will be used? Lump sum. B. It's gonna pay. It's gonna pay you lump sum. Just give you all the money. That's how that works. All right, next one. Which of the following is true about non-forfeiture values? Policy owner does not have the authority to decide how to exercise non-forfeiture values. They are required by state law to be included in the policy. They are optional provisions. A table showing non-forfeiture values for the next 10 years must be included in the policy. Which of the following is not true about non-forfeiture values? What do you think, Gris?
I think it would be A.
Non-forfeiture policies do not have authority to decide excess on non-forfeiture values. No, they require the state law the option or provisions. A table showing non-forfeiture values for the next 10 years. I'm gonna go with A2, but I don't know, to be honest. There it is. Screenshot that. They are required by state law to be included in the policy. Interesting. I didn't know that. Good to know. Which of the following is true regarding the spendthrift clause in life insurance policies? Spendthrift clause in life insurance policy. It is only used when the beneficiary is a minor. I think that's it right there.
What
Dang.
is spendthrift?
Spendthrift clause, it protects the policy owner proceeds from creditors of the beneficiary. So I don't know. It's not like a specific word. It's not like a vocabulary word. I think it's kind of like made up. But what it means is that when somebody dies, like me, for example, let's say I owe money to Bank of America and Chase Bank because I borrowed money from them, and then I die, and my wife gets a life insurance proceeds. The spendthrift clause protects my wife from these banks, these creditors going after my wife for the money that I owe. You know, it's just like, it's not because the death benefit is hers. I'm dead, so the bank's lost already. They can't go after my wife. They're gonna try to, but that's what the spendthrift clause does. It protects the policy proceeds from creditors of the beneficiary. Okay, next one. A 40-year-old man buys whole life policy and names his wife as his only beneficiary. His wife dies 10 years later. He never remarries and dies at age 61, leaving 2 grown-up children. Assuming he never changed the beneficiary, the policy proceeds will go to the... So it's going to go to the estate, A, because he never added his kids as beneficiaries, so they're not getting the money. The state is getting the money, and maybe eventually they will eventually get the money, but the estate first gets the money, and then the money is distributed to the kids, depending on the courts, depending on the wills, on the trusts. So when a life insurance policy was issued, the policy owner designates a primary and contingent beneficiary. Several years later, both the insured and the primary beneficiary die in the same car accident, and it is impossible to determine who died first. Which of the following will receive the death benefit? The contingent beneficiary. The contingent beneficiary is the backup beneficiary. So primary beneficiary, and then if they're not there, then the contingent beneficiary gets the money. All right, cool. We barely passed. You know, when you're doing these quizzes, always review the quiz so that you could see if you got the question right or wrong. I mean, to understand why the answer is the answer. All right, life policy riders. That's the next chapter. An insured purchased a 15-year level term life policy with a face amount of $100,000. The policy contained an accidental death rider offering double indemnity. The insurer was severely injured in a car accident and 10 weeks later, and after 10 weeks of hospitalization, died from the injuries. What amount would his beneficiary receive? So he died within 90 days. 10 weeks times 7 days per week is 70 days. So he died within 90 days. So he's going to get 200,000, double indemnity, double the coverage. If he would have died 90 days after the accident, then the death benefit would only be 100,000. The double indemnity wouldn't kick in because you have to die within 90 days for that to kick in. All of the following are features and requirements of the living needs rider, except living needs rider. Diagnosis must indicate that the death is expected within 3 years. It is usually available at no additional charge. The remainder of the policy proceeds payable to beneficiaries at the insured's death. It provides funds for medical and nursing home expenses to a terminally ill insured. It's either A or B. I'm going to go with B. Let's see. Dang, it's A. So it has to die within 2 years. Got it. Has to die within 2 years. Okay, next one. All of the following topics may be included in the continuing education requirements for long-term care insurance, except the effects, the sales techniques. Yeah, they don't. Continuing education doesn't have to do with sales techniques. That's something you learn at your office or from your trainer, right? Continuing education, they just want you to know the laws, regulations. You know that you're aware about the laws. All of the following are responsibilities of every long-term care insurer in California, except all the following responsibilities of every long-term care insurer in California, except establish marketing procedures to assure excessive insurance is not sold or issued. Submit to the commissioner a list of all the agents, authorized individuals. Provide enough business to solicit long-term. Yeah, that's the one. They're not in charge of giving you business to sell long-term care insurance. It's just, that's not the role of continuing education. It's kind of same as the previous question. The waiver of cost of insurance rider is found in what type of insurance? Waiver of cost of insurance. Waiver of cost of insurance. It's in universal life. Why is it in universal life? Because cost of insurance goes up every year. So if you have a waiver of cost of insurance, then the cost of insurance doesn't go up every year. So it's universal life. A long stretch of national economic hardship causes 7% rate of inflation. A policy owner notices that the face value of her policy, life insurance policy, has been raised by 7% as a result. So it's keeping up with inflation, right? Which policy rider caused this change? It's called the cost of living rider. Cost of living rider increases based on inflation. Increases based on inflation. Gotta remember that. The rider in a whole life policy that allows a company to forgo collection of premiums if the insured is disabled is called waiver of premium. So waiver of premium is a benefit that if you were to become disabled, the company pays your premiums for as long as you're on disability. So it's basically like having free insurance. It's just like having free insurance. Next one. Every long-term care insurer in California must submit a commissioner list of all the agents and other insurers representing authorized to solicit individual consumers for the sale of long-term care insurance. These submitted agents lists must be updated at least, I don't know, quarterly, semi-annually. I had no idea about that one. Semi-annually, don't forget. An individual is purchasing a permanent life insurance policy with a face value of $25,000. While this is all the insurance that he can afford at this time, he wants to be sure that additional coverage will be available in the future. Which of the following options should be included in the policy? Guaranteed insurability rider, because he wants to be able to get more coverage in the future without showing proof of insurability. That's the guaranteed insurability rider. That's what it's all about. Okay, next one. A rider that may be attached to a life insurance policy that will adjust the face value based upon the specific index, such as a consumer price index. This is the cost of living rider. So this is the second time they ask us a question about the consumer price index or inflation. Anything that says consumer price index or inflation is the cost of living rider. The insured under a $100,000 life insurance policy with a triple indemnity rider, that means if he dies, the coverage is triple, for accidental death was killed in a car accident. It was determined that the accident was his fault. The triple indemnity rider specifies that the death must not be contributed by the insured in any matter. In this case, what will the policy beneficiary receive? Well, he's not getting triple, but he'll get double. I mean, he'll get the coverage amount, which is 100,000. There it is. Screenshot that right there. Has a full explanation. After a back injury, an insured is disabled for a year. An insurance policy carries a disability income benefit rider. Which of the following benefits will he receive? Disability income benefits. He will get monthly premiums. No. Yearly annual waive income. I would say D. No. Monthly premiums waived and monthly income. Got it. So he's gonna have his premiums waived and receive income. Okay. Did we pass it? Yes, we did, barely. All right, cool. All right, Gris, look, we got, what is it, 5 more to go. You know what, annuities? I'm gonna knock out annuities real quick. That's easy. Let's do it together. Here we go. Annuities. Annuities is a topic that a lot of people always have questions and concern. I mean, just challenges with studying. So I have a video of what is an annuity, and on the Telegram, you could watch it there. It has a very, very good explanation about annuities. An annuity owner is funding an annuity that will supplement her retirement because she doesn't not know what effect inflation may have on her retirement dollars. She would like to return that is equal to a performance of the Standard & Poor's index. So she wants to buy an index annuity, equity index annuity, because it's tied to the index called the S&P 500, Standard & Poor's 500. Next one, which of the following products require a securities license? Variable. Anything that has a word variable requires a securities license. Don't forget that. All of the following are true regarding qualified annuities, except funds accumulate on a tax-deferred basis. That's true. Employer contributions are not counted as income to the employee while the plan is in force. I think that's it. Also, that's true. At distribution, all amounts received by the employee are tax-free. Nope. That's the answer. That's because that's not true. So A, B, and D are true. Make sure you pause this video right now so you can read A, B, and D, and then read the rationale. Do that on the replay, Gris. Which of the following is true regarding variable annuities? The person selling variable annuities is required to have a life insurance license, yes, but also a securities license. But A is overall a true statement. The annuitant assumes the risk of the investment, yes. The funds are invested in a company's general account. No, they're invested in a separate account. Ah, dang. I thought it was asking for all of the following are true except. Okay. So my bad here. The answer is B. That's the only true statement. So A is wrong because look at this. Tricky bastards. Look at this. It has the word only. And that's not true. You need a life and securities license, not just only a life license. The funds are invested in the company's general account, no, a separate account. The company there's no guarantees on anything that has a word variable, no guarantees. Which of the following best describes what the annuity period is? Annuity period is when you're receiving the money. So let's find out which one it is. The period of time during which accumulated money is converted into income payments. Yep, that's the answer. Screenshot. Next. What license or licenses are required to sell variable? Remember, you need a life and securities license. So both life and securities license, the answer is C. The answer is C. Next. Which of the following is not true regarding life with guaranteed minimum annuity settlement options? Which of the following is not true regarding the life with annuity guaranteed minimum settlement options? Payments can be made on installment basis on single. It does not guarantee the entire principal will be paid out. That's the answer, B. It guarantees that the entire principal will be paid out because it pays for a guaranteed minimum, pays for life, but if you die before, you're going to get some of the money back. I mean, the rest of the money back, whatever's left over back. As it pertains to IRA eligibility, which of the following would not be considered earned income? Well, B is unemployment benefits. If you're unemployed, you're not earning any income, so therefore that's unearned income. And you could put in any money into an IRA if you have earned income. In an annuity, the accumulated money is converted into a stream of income during which time? The annuitization period. Remember, annuitization is you receive income. And an accumulation period is you're growing your savings so that later on it turns into annuitization so that you could receive income when you retire. What qualifies an individual to contribute to an IRA? Earned income. We just went over this, right? To contribute into an IRA, you have to have earned income. All of the following are true of an annuity owner, except the owner is a party who may surrender the annuity. Yep. The owner must be the party to receive the benefits. No, the owner could be the one receiving the benefits, but the one that receives the benefits is the annuitant. So if the owner is the annuitant, then yes, he receives the benefits. But if the annuitant could be somebody else besides the owner.
Mm-hmm.
What happens if a deferred annuity is surrendered before the annuitization period? What's up, Chirita? What happens if a deferred annuity is surrendered before the annuitization period? The insured can only apply the surrender value towards another annuity. Deferred annuities cannot be surrendered prior to annuitization. Yes, they can. The owner will receive the surrender value of the annuity. C is the answer. So if you surrender a policy before you're supposed to, you're going to get charged a thing called a surrender charge. Okay, it's a penalty for surrendering your policy early. So what are you going to get if you surrender it? You're going to get a surrender value, which is your cash value minus your surrender charge equals surrender value. All right, listen to that over and over, man. That's explained perfectly. All right, we're pretty much done. I'm gonna post this up on the Telegram for life exam prep class, and that's gonna help out with your understanding of this topic. And what I want you to do is also view the videos that are on that Telegram. Okay.
Yeah.
The video here is not public, so you're not gonna be able to find other videos on this YouTube channel, but that I'm posting it in. But on the Telegram, the videos are not public, but they're unlisted. That means if you have the link, you could watch it, but all the videos are on that Telegram. So check out the Telegram and you're going to be able to watch a ton of great videos. So make sure you do that. But in your case,